So again, if you don't want to be recorded, simply turn your camera off during this time. So Mark, why don't you take it away? I'll let you introduce yourself and Shared Capital. And
great. Yeah, thank you very much, John. Hello, everybody. Happy to be here today. Going to talk about, well, what John said. Want to talk about kind of financing these conversions. What do lenders think about? What are we looking at? How do we be prepared for that? We'll come at it a few different ways. But let me see. Let me get my screen sharing going here, and then we can make it official. Slideshow. How does that look? Everybody see the first page there? Wonderful. Yeah, I want to talk about Shared Capital a little bit, so you kind of know who we are, and I can also reference, there's a few other loan funds that operate in similar ways to us around the country, and talk about sources of capital for cooperatives and business conversions. Talk about how investors and lenders think about underwriting and risk analysis and why they ask all these ridiculous questions, and then come back to us with more questions. Talk about some specifics in that underwriting that are particular to cooperatives and unique to co-ops, and then see if there's anything else we want to talk about. Throughout the presentation, I strongly encourage folks to ask questions as you want. I'll take a few pauses in here and there to make it official, but always appreciate having more of a conversation if possible, rather than just me being a talking head. So we can work on that. So I'll talk about myself a little bit so you know who I am. So I am the Senior Loan Officer with Shared Capital Cooperative. Been with Shared Capital for about almost 7 years now. Prior to that, I spent 10 years in Chicago with the Chicago Community Loan Fund, a mission-based lender financing of a large variety of affordable housing and community development projects, including cooperative housing and a few cooperative businesses in the Chicagoland area. And I've been working with co-ops for, gosh, almost 30 years now in a variety of forms and fashions, from financing to development to troubleshooting and turnaround plans and things like that along the way. And was able to bring my interest and experience in underwriting and my interest in the co-op world together when I joined staff at Shared Capital Co-op. So happy to move along here. So Shared Capital Cooperative, as our name implies, we are a cooperative. We are a small business lender. We provide most any kind of debt financing that a small business might need, from working capital to inventory to equipment and vehicles and real estate, conversion financing. So a variety of most anything that might be needed, some lines of credit as well. And we are dabbling in the world of equity investments too. We've made just a few of those over the years, and we're trying to roll out a more formal program around that. So we have some pilot investments we're working on right now, but I'm hoping over the next year or so, we will have more cash that can be available as true equity investments into cooperatives as well. And so in order to be eligible for financing, you must be some form of cooperative. And that could be anything from a worker co-op to a housing co-op to a farmer-owned producer co-op or a consumer-owned grocery store. As long as you are owned and operated on a cooperative basis, you're eligible for financing. And as our name implies, we are a co-op ourselves, and we are owned by the cooperatives that invest in us and the cooperatives that borrow from us. So you're actually required to become an owner, very similar to a credit union, specifically for cooperative businesses. And we work across the country, make loans as small as 10 or 15,000 and as large as $1 million, and can go larger than that when we work in partnership with other lenders around the country. So essentially, our mission is to create economic democracy by investing in cooperatives. And so we were started about 40 years ago, and with some co-ops that couldn't find banks that understood what they were, and created what became us. I've got a handful of slides with pictures on them, and I'll maybe just sort of call out, let you know who's in the photo, so you have some reference points too. This is a bakery in Los Angeles called Proof Bakery that converted last year to worker ownership from an independent business. As I said, we're democratically owned and operated. We have about 300 co-op members around the country. about 100 borrowers right now in our portfolio. We're on the small side when it comes to lenders. We have about 21 million in assets. And we are what's known as a CDFI, Community Development Financial Institution. And really that's a designation by the US Treasury for mission-based lenders and investors. And so if you're looking around for financing, CDFIs are sometimes lower hanging fruit available to co-ops. Not all CDFIs understand the model, but there are a growing number that do. And we fit into that category. And about 40% of the money we have to lend out comes from co-ops that want to invest in the co-op economy. And then, of course, our members govern us as a co-op by serving on the board of directors or committees. When we're thinking about money and co-ops, we want to think it takes a little bit of a shift from the rest of the business world and the rest of the economy. And that's intentional. And we want to think slightly differently about how the cooperative members and the cooperative itself relate to any capital that's coming into your business. And there are a few principles that I sort of call out when I think about how money moves through a cooperative, and principles that we are hopefully able to apply when we are borrowing or investing or moving capital around in the co-op economy. And one is that principle 3, that all co-op members invest in their co-op and members benefit from those profits. And so when we're making a loan into a co-op, we want to see that that's really happening, that that's truly a part of the business model, that the patron members, the clearly defined membership, are the ones that own, operate, and benefit this business. But we do want to see members putting some money on the table. And that can be very different amounts in very different circumstances. So it's definitely tailored to the situation. We'll talk a little bit later maybe about share prices and how members purchase those shares to bring equity to the cooperative. And we have cooperatives that have share prices of $10, and we have cooperatives that have share prices of $20,000. And there are different reasons that those different sizes are in place. We can talk about that. Co-ops should never compromise their autonomy or their democratic control for their money. This can be a challenging one. In most of the economy, equity investors are expected to take some control and take some ownership and have influence over the business that they are putting their equity into. And in the world of co-ops, that's one of the challenges we grapple with, is trying to find equity that will set back and maybe offer advice and be available for assistance and offer some guidance, but not actually taking control of the business so that the members maintain that control. So we want to think about that when we look for our capital. And then principle 6, we like to kind of brag about, because that's the nature of shared capital, is co-ops work with other co-ops to build a stronger economy. So we want to see co-ops investing in co-ops. And that's essentially our model, a place for co-ops to put their money that can do good in the co-op economy. I'll pause for just a moment there if there are any reactions. And actually, I guess we should have clarified, how do we prefer to do questions? Are people using a raised hand or the chat? I don't know if you have a standard.
We don't really have a standard, of whatever is going to work best for you.
Okay, great. We'll try to keep an eye on those.
And I can help monitor the chat as well.
Thanks. So where do co-ops find this capital? Well, it can come from a variety of places. And this is not a comprehensive chart by any means, but it is a map of kind of typical sources of financing and how those sources of financing show up in the cooperative's balance sheet and capital stack. Just looking at the top, we've kind of broken down on the left-hand side, we've got forms of equity in grants and donations, the common stock, the membership stock in a cooperative, and preferred share stock or other equity forms of equity investment. And then as we get to the right, we've got things that are more real debt. They could be subordinate loans or senior loans that are typically structured with amortizing payments on a schedule. And so, whoops, that was get ahead of myself here. Oh, technology problems. There we go. Sorry about that. And looking down below, we can kind of see, where do co-ops often find this kind of money? So the more flexible money, the money that you can use as you see fit, and that will be paid back based on your returns and profits, is going to be on that equity side of things. And so you're going to turn to your members. You're going to turn to often crowdfunding campaigns, local investors, family and friends. You may find some sources in foundation investments of some sort, or just straight up public subsidies and tapping locally small business grant programs and things like that. As we move to the right, was kind of sitting in the middle there, preferred stock or different forms of equity investments can come from a variety of sources. Again, your membership can be one of those sources in addition to their common stock investments. You may turn to CDFI and mission-based funds. You may turn to other cooperatives directly investing in your co-op. So that happens often on a regional basis. A successful co-op that has some extra assets may occasionally directly invest that into another co-op that's in development. We'll talk about seller financing in conversions specifically. And then we get to the bottom again, it's more kind of mission-based areas, impact investors, foundations, and public subsidy again. And then as we look at real sources of debt, subordinate loans or senior loans, you're going to see a lot of those same players in that space, but you're probably going to be spending a little bit more time with mission-based lenders, and then occasionally banks and credit unions. We can get into a little bit more if folks want. There are certain hurdles among regulated financial institutions that can sometimes make it difficult to provide a loan without requiring a personal guarantee for one or two people. We want to try to avoid that if we can. Sometimes it's inevitable. And that's why some of the more unregulated institutions like CDFIs and other smaller funds have a little bit more flexibility when they come to that, and can tailor some of the terms of their loans to better reflect the structure of the cooperative itself as a borrower. I'm going to pause here for a moment because there's a lot of stuff on that chart, and see if folks have any thoughts or feedback or questions about that. Okay, not seeing any. We'll move right along. So when we're looking specifically at conversions of businesses, we're usually narrowing it down to a couple of sources that we have typically seen over the last several years as becoming fairly common. And that's some form of outside debt, which could be a senior lender or a combination of a senior and a subordinate lender. Some form of seller financing, either in the form of a straight up promissory note and debt, or in some form of earnout formula based on earnings and the success or challenges of the business over a few years. And then of course, member equity and sometimes member debt coming into the equation. And then other sources, usually that's referring to maybe a crowdfunding campaign or donations or a Kickstarter or something like that, for a smaller scale transaction can play an important role as well. And I've just for your own reference, kind of put in there what we've seen across the world of conversions to cooperatives over the last several years, kind of where we sit in the 20 or so transactions that we have financed over the last several years, and what we're seeing kind of across industry norms. And there's quite a bit of range, and that has to do with the fact that there are quite a few conversions that are not capital intensive at all. They're buying, so it's a smaller retail business. They maybe don't need to buy a whole lot of equipment. Maybe they don't need to buy any real estate, and so it can be a little more straightforward, and may not have to turn even to very much outside debt at all. And then on the other side, we're occasionally seeing some larger manufacturing companies where there's a significant capital raise and prices in the tens or 20s millions of dollars for the sale of the business. And those are going to get a little more complicated and push some of those percentages up or down depending on the line item. Now we'll come back a little bit more and talk about what we as a lender prefer to see in seller debt and seller earnout financing. And I think you'll be talking about that a little later too as well. One thing to highlight here is that so far in the businesses that we have worked with and that have been worked with across the country that we know of, the member equity is actually a fairly small percentage of the total transaction and the total capital stack. And that is often very intentional. Again, it can depend very much on the type of business, what sector it's in, what kind of turnover you might see in employment, and those kinds of factors. And so one of the motivators for keeping it very low, of course, is that you want to not have too high of a hurdle for people to become members and member owners of this business. But sometimes it is driven by the necessity of having to turn to your membership for extra cash in the transaction, and that might raise that number a little bit. When a new cooperative is starting up and they're trying to figure out what their share price should be, our sort of non-answer rule of thumb is that it should be a meaningful amount. So you want it to be enough so that people have to think about it, and they think a couple of times about it before they write that check or make that payment, but not so high that it is preventing people from accessing membership. And in the conversions especially, we want to think about, are there any other financial products that are needed that may or may not survive the conversion? So lines of credit, credit cards, general business banking needs. There's going to be sometimes a new corporation created, sometimes not. Sometimes that can trigger the need to reapply and recreate these accounts. Again, the question of needing personal guarantees on certain lines or credit cards may drive your decision one way or another. We have found that it is, not frequent, but it is fairly common that we need to work on providing a line of credit alongside the financing of the conversion, because the local bank or credit union that was previously working with the co-op wasn't able to get comfortable with providing that, was previously working with the business before it was a co-op, wasn't able to get comfortable providing that same facility to the new structure. And so there are cases where we've been able to bring that alongside, or we've helped a local lender kind of get comfortable with that and figure out a way that works for everybody. So digging into kind of why lenders think this way, how do they think? It all depends on what kind of a lender you're talking to, what kind of an investor you're talking to. And these are sort of the things that are going into their mix of analysis on figuring out how risky is this investment or this loan. They are driven not just by their underwriting and where you fit on a credit score matrix, but they're driven by their own mission priorities, the regulation or lack thereof that they need to follow. They are also driven by local politics and their sources of capital and impact goals and local priorities for the local economy. And so all of those things are going to factor into what kind of a relationship you can build with what kind of a lender or investor. And it really is a relationship. They're bringing their money to your business. You want to be able to have an open line of communication with them. You want to be able to make your case to them that you fit their priorities and that their needs for these various motivations. And so when we're looking at the actual underwriting itself, we're going to look at a lot of the typical things that people are looking at for any business loan. We want to understand that cash flow, how money moves through the business, collateral, the management capacity, the market it's in. And then the unique things here is we want to unpack and understand that transaction structure that's being proposed, the purchase agreement, how it's set up. And then in particular, the unique elements for co-op underwriting are that we want to very truly understand, what does ownership mean in this case for this co-op? What does governance look like? And how is equity and patronage handled within the co-op? And then it sounds like you'll be talking about some of those equity and patronage questions as well in a little while. So we can dig in a little bit into each of those things. And I'll kind of just touch mostly on the high level here, and we can dig in conversation at the end too, if you want, with any follow-up. Cash flow, of course, the primary source of repayment. This is where the money comes to hand it back to the lender to pay down that debt. And so we obviously are going to want to look at the historicals of the company before it converted to understand how it's been doing. And then we want to understand how that shifts going forward with the new ownership structure, the new priorities for issues around payroll and benefits and how those map out. And the fact that there is no longer a single or small group of owners who are making draws on the capital of the company. So making those adjustments into the projections and looking forward, we've got some debt service coverage minimums that we want to hit. So we want to know that you can generate enough cash to pay your operating expenses and have more than you need left over to pay the debt. So that extra cushion in there allows for the inevitable surprises and emergencies that happen to any small business throughout the year. Oops. Okay, collateral and security. This is important. It's not as important really as that cash flow question. I know from our perspective as a mission-based lender, we never want to get to this point of having to look at collateral and other forms of security. And so we're doing whatever we can to modify loans and adjust loans and work with the borrower to adjust the terms to meet their situation if they meet a rough patch in the business. But from time to time, businesses fail, and then we have to step in and look at collateral and security. We do quite a bit of lending that is unsecured, but we do take a lien on all business assets. And so it's there for whatever it's worth. And that can, of course, change by the nature of the business and the sector it's in. So things like equipment and inventory, other assets, they have a somewhat limited application when we're looking at a conversion transaction. Again, we're really relying on the history of that business and its effectiveness going forward. Real estate, of course, is a little bit unique in these transactions. There are oftentimes when the conversion facility and the financing of the real estate are two separate loans with their own terms and structures that sit side by side. And of course, then if we peel off the real estate part of a financing of any conversion, we're going to be looking at fairly typical parameters. So, maybe a maximum 80% loan to value, debt coverage of 1.2 or better, those kinds of things that are going to be assessed on their own in parallel with the assessment of the company's conversion. And again, I talked about it a little bit, but there are rare occasions where we look to personal guarantees to bring us some extra assurance in the success of the business. But it is not a common element of our transactions. And so it's been a while since we've actually used personal guarantees on a loan, but occasionally for maybe a 3-person business that's a startup, there's no collateral, we're a little unsure about the market they're in or the product they have, we might ask for partial proportional guarantees. So each person is only guaranteeing their percentage of ownership in the business. And we don't place a lien on personal assets. It's not our purpose to take somebody's car or their house or whatever they own. So we draw the line there. And we really use these guarantees to keep people around if things start to go bad. So we can sit down together and work out what the best case of a worst case scenario. Management and leadership, of course, we want to know understand the capacity of the co-op moving forward. Of course, it is common and typical that the great majority, if not all of the workers, are going to be in place after the conversion happens. And so obviously you've got consistency and you've got experience and you've got knowledge of this business that is staying with the cooperative. But sometimes management roles are shifting. Sometimes the seller hasn't been active in the business for years. Sometimes they are still a key component of the business when the conversion happens. And so we want to see how that capacity is being replaced or spread around. Sometimes there's a need for some cross training as the co-op is developed to cover different roles and responsibilities in the business. We think it's a great thing if you turn to outside assistance for these things. We definitely don't see that as a weakness. But in the underwriting, if we see some gaps in capacity or any of the other elements of underwriting, we'll encourage our borrowers and sometimes require our borrowers to find extra assistance, either that consulting or training or technical assistance to really fill that hole that we see there. Of course, then market conditions and kind of where this business sits in there. And here too, if there's a track record for this business and they really know their market, that makes it a lot easier. But there are many industries over the past few years that have stumbled and changed dramatically from pre-COVID days. And so we do want to understand, how has this business weathered these times? Are there any substantial fundamental shifts in their sector of the economy? How are they planning for that or grappling with that? Nobody has a crystal ball, but we want to know that you're thinking and asking yourself these questions and trying to think ahead to anticipate as much as you can going forward. There is also an element of conversions that, and this may drive whether it's a stock purchase or an asset purchase or a form of merger for the conversion, but the need to maintain existing contracts and relationships in your business. So sometimes just keeping that tax ID number is fundamentally important for a business that maybe does a lot of government work. And if they lose that or have to change that ID number, they get pushed to the back of the line, whereas before they were at the front of the line. So those kinds of things could destroy a business very quickly. And so we want to make sure that the structure of the conversion is helping to maintain that the stability of that organization. I've mentioned a couple of these things already, but we're going to underwrite that transaction. It is always good to give yourself enough time to do it right. There are some times when we get calls that said, hey, we need to convert this business in 30 days because the owner is running away. That might be a red flag. There might be a reason that the owner is running away. And so we're going to want to understand what's going on there. And we understand that there are some times when timing is unavoidable for whatever reason, and we can work to move things along as quickly as possible. But giving yourself as much time as you can to onboard each other into this new co-op structure, to make sure you thought through all the elements of the transaction right, to make sure that you've negotiated as best you can through that process for all parties is always preferred. Again, we like to see that there is experienced professional assistance through that transaction. So there's somebody there that can help facilitate the process, some group that's done it before or individual that's done it before. The sale price, our preference generally is that we have a third-party valuation. We don't always require that for smaller dollar transactions if we can get comfortable and familiar with the industry and the sector that they're in. But once you get up above $500,000 or $750,000 or $1 million and above in price tags for these transactions, then we're probably going to want to see a third neutral party give a stamp of approval for the valuation. Of course, business valuations are like real estate appraisals. They can be shifted and driven in different ways. They are more art than science. And so just having that number isn't enough. We're going to want to understand how that number was developed and what kind of factors were played into that. And then another important thing is to understand what is the seller's involvement post-conversion. And we've got a lot of different scenarios here. Sometimes for their own reasons, they need to move on and separate from the company very quickly. Sometimes they've been here forever and they built a family and they don't need to go anywhere and they want to stick around for another 3 or 4 years. That can be great too. Sometimes they maintain a board position for a while or stay on as a consultant or advisor for the business. And then, like we saw earlier, it is common that they play some role in the capital stack in the financing too. Those can all be good things, and sometimes those can be very challenging things. And so it's there too. It's good to have full transparency, fully understand the power dynamics of what's happening. So that you don't end up in a situation where you now have a cooperative owning this business, but there's still that seller that's a member of the co-op and people still defer to that person on decisions. We haven't really created a co-op there if one person is still really driving all the decisions. And so we want to unpack that a little bit and make sure everybody's comfortable and really understands what the things will look like going forward. Back to that seller financing role. This is sort of things that we like to see. And again, we don't always put a lot of hard and fast requirements in what we need to see, but our preference is that if the seller is financing with debt, Oh, wait, I'm sorry. There was something in the chat.
Yeah. Hey, Mark,
ah.
it's Michael here. Yeah, I'm curious. You made mention in the previous slide with regards to some of the challenges and benefits, obviously, of a seller's involvement post-conversion. Can you give me some examples of where those challenges lie? I mean, yeah, and I'm just trying to kind of conceptualize this specific to our work group's, reality.
Yeah, yeah, and I so the example I cited is one scenario where it's really kind of it's nothing on paper and it's nothing financial. It's simply a power dynamic that may exist in the ongoing co-op where that person, because they've always been in charge, continues to effectively be in charge and not hand over that authority and responsibility to other people. So that's one difficult circumstance. There are other times when we've come into a situation where they are proposing that the seller ends up with a better situation as an ongoing employee than all the other workers. And so a transaction where they said, well, they were going to demand a certain salary for the next 3 years, or they were going to demand a certain number of hours in contract work or things like that. And people can come to those agreements and it may make sense for the co-op and it's not necessarily a bad thing. But sometimes we've seen where the co-op needs to tighten their belt a little bit and suddenly we're back to the situation where the previous owner is making a lot of money and other folks are maybe making not so much.
Right.
So there are different ways that can play out. But I will say, more often than not, having them around for a little while is actually a very good thing. From our perspective, it's a big sign that they're not walking away from a dumpster fire, that they really have faith in this business going forward. And if they've got faith in it and they're willing to bank on it by sticking around, that makes us feel better as a lender.
Great. Thank you.
Sure. Yes, so when we're looking at the terms and conditions of seller financing, if we're looking at a role of seller debt, we typically need it to be subordinate to our debt, and it's typically going to be subordinate to any conversion financing debt coming from outside. And that effectively means that if the co-op is short on cash and can't make payments to all of its debt, the senior lender gets paid first, the subordinate lender gets paid second. Similar to if everything falls apart and there are claims made on collateral, the senior lender gets first, subordinate lender comes in with what's left over. We also want to see typically that the maturity or the term of the debt is either aligned with or slightly longer than our financing or the outside financing. Most often it sort of runs in parallel. There are circumstances where we can allow for a shorter term on it. And so it's not a hard and fast rule, but it is a strong preference. And then we want to make sure that, of course, with the amortization of that it's a clear structure and predictable payments and reasonable payments. And we want to know that, of course, that the debt service coverage, that the cushion for making debt payments incorporates all debt into those formulas. When we're looking at earnouts, it can get a little more complicated because there's a large variety of ways that people can come at these earnouts. A big advantage to an earnout is that it can sometimes be a helpful negotiating tool in bridging the gap between what the seller thinks they should get and what the co-op can actually afford or thinks they should offer. And so we fairly often see structures where there's an earnout and there's a minimum amount that is somewhere a little bit below what the co-op wanted to pay, and a maximum amount that is somewhere around or above what the seller really wanted. And so then, they're getting some baseline that still fits the formula, and they're only getting more if the business is doing really well. And so we can often live with those, again, as long as they are transparent and the metrics used to calculate those things are, everybody's on the same page about which line item we're using to calculate those things and stuff like that. Our preference is usually that if there's earnouts based on surplus, that it's based on an annual EBITDA, a net income, or other, clearly defined performance metric. And then there may occasionally be in that formula incentives to accelerate the exit of the seller. So sometimes we talked about roles that the seller might play. Sometimes if there is an earnout, the seller wants to have a permanent seat on the board, so they get one seat. They're still the other workers still have a super majority, but that seller has some influence there, which isn't all bad. But they may have a 5-year term to pay that earnout to them. But there may be formulas in there that allow the co-op to pay it all off sooner, but there's probably a penalty to pay it off quicker. Or the seller could call it sooner, in which case there would be a penalty to the seller to call it sooner. So there are a lot of nuances and a lot of different ways you can use the earnout as a way to kind of, again, bridge that gap and negotiate the structure and hopefully find some middle ground for everybody. The issues unique to the cooperatives, then, just a handful of things. And I think you've been talking about some of these things already in other sessions or in the future. You know, how does somebody become an owner? What are the benefits and rights and responsibilities of that? What kind of onboarding mechanisms do you have so that people really can act on leadership opportunities and can grow in their role in the cooperative as an owner? So we want to see those things laid out either in the bylaws or operating agreements or certain policies and procedures around membership, so that we understand what it means to be a member. The governance, we want to know that it's transparent and clear established policies around that. What kind of authority does the board have? What kind of authority do the members as a whole have? What is the relationship with management? In some larger co-ops, you may see the co-op hiring a management position or two that is not a member of the co-op. They are simply employees of the cooperative, but they perform these roles for them. And sometimes and often they are part of the membership, but they have a different element of power in there. And so want to know kind of how those things play out when it comes to decision making and authority in the co-op. And then equity and patronage, which you'll be talking about, but we talked a little bit about this already. How did you come to the amount that you think your shares should be? How are they paid out to exiting members? You don't want to shoot yourself in the foot by requiring that you pay out the entire amount and then lose a couple of members down the road. Does it change over time? Typically in a worker cooperative, it doesn't, but in other forms of cooperative ownership, that equity, that share value might change over time. And then of course, how do you manage your surplus, allocating it between internal capital accounts or patronage dividends or holding dollars on behalf of the members or keeping it at the co-op. So that's what I got to say. I hope this was informative and helped with things you've been thinking about as you think about your conversion work. And I've got time to stick around for comments and questions, but feel free to reach out to me as well. You got my email and my cell phone right there.
Wonderful. Yeah. Does anyone have any questions or reflections? And not commanding one, even from Northwest Co-op Development Center? Feel free to jump in.
Mark, it's Michael again. Thank you for taking the time to present this. This is super helpful in kind of highlighting some key areas of consideration for Trillium specific, pursuit of a co-op conversion. Super informative. I probably will at a later date potentially follow up with you with some prescriptive questions. We're just trying to organically, and naturally kind of navigate through this process so that everybody's at the same level of understanding of what we're trying to do. And from a service offering, that the underwriting services, it's helpful for us to be exposed to at this time. So thank you.
Great. Yeah, glad it was useful.
And I have one just in general, and I realize every project has its own unique things, but how much time should buyout committees plan for getting through the process and arranging it around closing, and what would be sort of the core documents that you would expect them to submit so that they can have that sort of calendar of the process if they need to?
Yeah, so we like to talk to people early. So, call me up now, even if you don't have everything figured out. so that we have a kind of a sense of what the thing is and what's going on, and get it on deck. But when things look like they're coming together and you've maybe, you're close to negotiating a price, you're starting to put some of the structure together, that's probably a good time to think about an application. Even if you don't have everything completed or finalized, once you have a sense of what these documents are going to look like, it's okay to apply at that point. What we would do is we can move forward with underwriting and make a decision and make the final review of those documents a closing condition of the loan. The time period between when we receive a fully completed application and the day when we can make a decision is often 4 to 6 weeks. If it's a very complicated structure, it could be longer than that. But that our loan committee makes the decisions meets once a month. So it depends on when the application comes in, whether it can meet the next meeting or it gets kicked to the following meeting. But 4 to 6 weeks is typical. Again, we'd like to have more time if needed, if there's so many complications in the deal or things to be figured out along the way. We're happy to offer feedback as you're building your drafts too. And then from commitments to closing is usually at least a few weeks, but is often driven by the mechanics of finalizing the deal, finalizing the documents, getting things incorporated. A lot of other things are usually driving the timeline once we've got a loan committed. But for us, we would need a couple of weeks to draft documents and get them finalized and get ready to close. And again, when you're applying, we're going to want to see historical financials for the business being sold. We're going to want to see projections going forward. It's okay that they're drafts. It's okay that you're still working on them. They are living documents until you've closed the deal. And then we want to see the organizational documents, the bylaws, the structure of it, and then understand the structure of the purchase agreement and the sale itself.
Wonderful, thanks. That's very helpful. And
I had a quick question. This is Evan at Blue Heron.
Yep.
Is there usually a fee for the application process, or does that come out of the your percentage of return on the loans?
There is a standard $250 application fee.
Okay.
But and then our standard loan fee between commitment and closing is 2% of the loan amount. But the application fee actually gets credited towards the loan fee if the loan is approved and closed.
Okay. Pretty reasonable.
Yeah, we try to keep these costs as low as possible. We've got UCC filing fees. We need to place a lien on all business assets. That might be $80 or $100. We've got a couple $100 in loan preparation, legal review, document prep stuff, but that's usually about it, unless there's real estate involved or if there's other layers or complications.
Thank you.
Any other questions or thoughts? Otherwise, I want to thank you, Mark. This is a great presentation. It's always great for me too to be able to see and get a reminder of what the process is as we help folks going through this, and thinking again about how important getting the financial model organized is really for buyouts, especially to get that working early rather than later. Was someone else in there real quick, or? Yes, well, then, yeah, I want to thank you, Mark. You're welcome to stick around for Luis if you want to, but I realize you're probably also very busy. So I will make sure, if you can send me a copy of the slides, I can put in the folder, and then make sure everyone also has your email address. And again, once again, thank you very much.
All right. Yeah. Thanks for your time. Happy to be here. Happy to help out. Look forward to chatting with you, some of you, in the near future. So take care.
Thank you. Bye-bye. Right. Let's turn it over to Louise and our next discussion.
Great. Thank you. I've been with NWCDC for the past year, and I moved up here from California, where I worked at the California Center for Co-op Development for I think almost 12 years. And yeah, so I'm now a permanent Washington resident living in Port Hadlock. And I've been through one conversion, one sale of a business to its employees and farmers. It's a multi-stakeholder co-op now called Feed Sonoma, and that was a deal that got completed early last year, and so I have that one experience of going through beginning through end. And here at NWCDC, I've been working on some startups in home care, and am currently walking through with a small business the process of employees purchasing the business from its sole owner. And I come from an experience that's where my financial understanding is all practical. I'm not an accountant, and I didn't take accounting courses. I learned this by sitting through a lot of trainings, especially oriented for ag co-ops and consumer food co-ops first, and then more recently around worker co-ops. And I understand that, and I got to see the slides from last week's presentation, and you got essentially an introduction to the vocabulary and the mechanics of financial accounting, and an introduction into equity. And I first want to start with a question for you to just answer in chat. On a scale of 1 to 5, how are you feeling with your understanding of the different financial vocabulary terms? So I'm going to repeat that question one more time. If you could just answer on a scale of 1 to 5, how do you feel you understand the financial vocabulary? Michael responded 7. Yes. That's impressive. Good. All right. Okay. Yeah. Yeah. I mean, for a lot, I was in the same position that a lot of you were, and I think I really had to go through, a specific training twice before I really felt a mastery of it. So I wanted to just start real quick to review some of the vocabulary so that you get an understanding of how, especially different sectors and between attorneys and accountants and lenders with varying degrees of co-op familiarity use different terms. So I'm going to start my little slide here. Hold on a second while I hit the appropriate buttons. I get to share. Then I hit my slideshow. Actually, I think I might have to. Sharing the wrong screen. Hold on a second. I've done this before. Here we go. Screen. Second one. Here we go. Excellent. Okay. Now you see one slide, right? Excellent. Great. Okay. So, and the part that I'm going to focus on is reviewing the equity part and showing you some other dynamics of how equity works in co-ops and what it means for members. So yeah, you've got the general idea that equity is essentially assets minus liabilities. And when we start talking about co-op finance, we start talking about allocated equity and unallocated equity. And we can also call allocated equity member equity, because that term allocation means it's attached to a person, to a member. And worker co-ops, one of the things that I learned more recently is that worker co-ops use the term surplus for this. And when we have unallocated equity, it means that we're essentially talking about permanent equity within the co-op that does not have a name attached to it other than the co-ops. Worker co-ops will use the word profits, but I mean, if you use the simple word profit for traditional lender banker, going to have a different understanding of what that means. And when we talk about patronage refunds, we're talking about, we can also hear people use the word patronage dividend. And here we're talking about the portion of allocated equity that's returned to its members. So that's the patronage refund part. I refer to as the cash part. And retained earnings, you'll hear everybody in business understands the word retained earnings. And we generally within co-ops talk about that is the combination of member allocated equity and unallocated equity that stays with the co-op instead of being returned. So I'm going to walk through some of these concepts with you. So, and I'm going to do that by using a different example. I got to see the example that was his name Chris, right? Who was the previous trainer?
Chris.
Yeah, right. And I'm going to do it on a more visual basis for those of you that learn a little bit differently. Maybe it'll your brain will digest it a little bit differently. And I always want to give thanks to Melissa Hoover for putting together this one that's this example here that I've been using frequently, and I've made a few changes here so we can look at how equity is handled or managed in future years, not just in this example for the 1 year. So here we've got a business, a co-op that has 650,000 in revenue. We've got costs and expenses of 549,000, which on your profit and loss statements means that at the end of that, you've got $111,111 in net income, net profits. And the co-op board gets to decide what happens to that $111,111. And so the first thing that this example co-op board is going to do is identify what portion of this came from non-members. And just hypothetically speaking, there were certain percentage of employees who were not members. And so the hours that they worked don't count towards our equity allocation. So right from the start, $11,111 becomes unallocated equity, and the co-op calls that profit. Okay, the second part, we've got our surplus, the remainder. $100,000 was generated by members. So this is now equity that will be allocated to members. Okay, and so we go to the next page here. So we got that $100,000 that we call surplus, that we call allocated equity. We've got to make some decisions here. And one of the things that is fairly unique to worker co-ops is the practice of taking some of that and unallocating it and turning that into a collective account, you can call that. You can call that also retained earnings. I put all these words up here because it's the same thing. It becomes the co-op's permanent equity. And so here, this board decided that $25,000 immediately is going to be taken out and can become permanent co-op equity. That leaves $75,000 for patronage, and part of it's going to be returned in cash, and part of it's going to be retained by the co-op. And so that's what these next steps look like. This co-op decides that half is going to be returned as cash and half of it's going to be retained. So there's your retained patronage, and it gets booked onto a member capital account. And that amount gets paid out in future years. And the board's going to make decisions in future years about how much of this original allocation to give out in future years. So the remaining $37,500, there is, let's see, we've got, so now we're going to bring into the example the individual members. And you can see right here, I want to bring to your attention, let's see if I can do my little annotate, see the little mouse here. So you can keep this straight because there's a bunch of, it starts to turn into number salad here. We've got $100,000, and that's what these two, you can see my mouse, I think, moving, 75 plus 25 here. And the amount that's allocated equity, that's patronage refunds material, is split in half, 37,500, 37,500. And then we start putting names on each of these and amounts. And so here we've got cash payments that go out proportional to each member's hours that they worked. And well, in this case, an equal amount that gets retained by the co-op, but has the member's name on it. So what happens in year two? We're gonna, yeah, so here's a little picture of it being saved. In year two, we're gonna say that the year was not so good. They have a surplus of $50,000. That's the, and we got $50,000 in surplus. And this co-op decides that it wants to keep $10,000 as permanent co-op equity in the collective account. It's unallocated. And the remaining $40,000, they make a decision also that instead of giving half in cash and half retained, they're going to only return 25% in cash. And that leaves 30,000 in retained patronage, and $10,000 for their cash payment. So in this case, just making up some different, each year members work different hours, and I just made up some numbers about our hypothetical 5-member co-op. And this is the breakdown of what is returned to them in cash and what's allocated to them in year two operations, right? So I want to show an example of what it looks like for the members in year two, because we already know what they got as their year one patronage refund check, and that is here. Year one was retained this amount, and the board decided in year two that they're going to return 10% of that amount that was retained originally, but they also had that net profit, net earnings in year two. And so they've got $10,000 to return as cash patronage. So they're going to, in total, give members 1,000. This member specifically 1,750. So the portion that's from year two, plus a piece of what was from year one. So that means that that members, on top of getting paid what they were paid on an hourly basis, are also going to be provided this patronage refund check. And the exciting thing is that this amount from the patronage refund that was retained in year one, the member has already paid taxes on that. So this amount comes to them as not being taxed. Only this year two patronage, the total allocation is going to be taxable to them. So this is one of these other benefits of co-op membership and ownership. So I want to stop real here and make sure that this hasn't turned into number salad. And if you have a question or a clarification in here, this is the time to ask about this specific example. In chat or in voice. Okay, yeah, Margaret?
Yeah, I actually have a couple of questions. The first one has to do with how you figured out the money that the members generated versus the money that the employees generated.
Oh,
that's a little murky. And
members versus non-member employees in this worker co-op.
yeah,
This was entirely hypothetical. Entirely hypothetical. So
right,
when we do that,
how does it even work?
oh yeah, well, we simply take we start with the sum of all the hours and find what each employee, member or not, what percent of total hours they worked. And then, so that's going to add up to 100%. And then we can take out those that are marked as non-members. That total percentage is what is right off the top taken out of this patronage allocation formula.
Okay, great. I get it. Then the next question had to do with on your screen, like your next screen over for year 2.
Mhm.
So you've got the total patronage cash, but what you don't have is the total retained.
That's on this page.
Okay, all right.
Here's,
That's my
so
question.
in their accounts, in their equity accounts, then, from year 1, they originally had a total of 37,500, and we paid out in year 2 10% of that. So that's what's remaining in the total member accounts. And then we have new money to put in there from year 2, and that's this retained patronage over here. That's the 75% of the total net earnings that was generated in that year. And so at the end of year 2, then total member equity is 63,750 that's sitting within the co-op. So, the main thing about this is that equity in a co-op it's pretty dynamic. There's always money going in and money going out. And so that's why it's important for boards to become educated on how to manage this and understand when they make a decision about, well, maybe we should give out 80% in cash. Well, what does that do to our cash flow? Are we handicapping ourselves by doing that, or vice versa? Balancing member needs and the co-op's needs to retain good employees as members. The patronage refund system helps with that. So yeah.
in year 3, do you then take a percentage of the total member equity, or do you take it by year? So
By the year.
By year. So you say, okay, well, year 2, you get 10% or 15% or whatever it is.
Yeah, it might be the next year that you decide to pay out the rest of the 90%, or maybe just another 10%.
But it would be
And
10%.
you're always looking at paying out oldest first, and not necessarily just taking some from year 1, 2, and 3, but you're going through these year by year. And at some point, there'll be no equity left over that was generated in year 1, and then you're working on year 2, what was retained in year 2.
Okay, got it. So if I'm a relatively unsophisticated member, how the hell do I keep track of what comes in, what goes out? What have I paid taxes on? What haven't I?
Yes. So, I mean, number one, the co-op needs to be the record keeper for these member accounts. And each year, when there is an allocation, the co-op needs to send what's called a written qualified notice of allocation. And it tells them exactly what they get, what they need to report on their taxes as being allocated to them. And when they get their patronage refund check, it should also come with an overview of their member equity account and what kind of activity has happened in there, so that they know exactly, so they will know what to put on their own personal income taxes, and what not to. So those are things that, that require the co-op having a good accountants that can help do this. Yes, Tori?
Well, I think you just might have answered my question. I was going to ask, is that generally something that's done by the secretary of the co-op board, or out that kind of financial bookkeeping? Do co-ops often outsource that to an accountant?
Yeah, whoever's going to do your taxes. So one of the important things here, and it's, we're getting into kind of level 3 or 4 of financial co-op accounting, is that when we talk about, making sure that you've got your, that you're allocating your net earnings, what you have on your records might be different than what you have reported on your tax filing, owing to depreciation and some other factors. So you want to work with your accountants to make sure that whoever's doing your taxes, that that you're using the right numbers. So this is something that we definitely recommend that be done in with the advice of the co-op's accountant.
Do co-ops generally like need an accountant that's a specialist in co-ops? I ask because my accountant's just like, what the hell are you doing right now, Tori?
Yes and no. Well, maybe I could let John answer that because I think you've got more experience with worker co-ops.
Yeah, I mean, I think having a co-op centric accountant helps just because they understand that the purpose isn't to drive up profit, right? And it's a different ideological concept about how you're using equity. However, in terms of the actual accounting, I would think most accountants would be able to process the numbers and divide and do the reporting. It's just whether they can get over the existential leap that it needs to take to realize that it's not really, profit isn't the center of the existence of the organization.
Yeah, and I know mine's currently struggling with that concept, and I've been pretty sure he called you, John.
Yeah.
Okay, great. Okay. So let's see. Checking to see if there's anything else in chat or another hand raised. No?
Annie had a question that I think is worth answering.
Say it again.
Let's see. Annie asked if this is for worker co-ops. Yes, but does the logic work across all forms of co-ops? What about multi-stakeholder co-ops?
Yeah.
And add another wrinkle to it.
Yeah, well, yes, that was the big challenge with Feed Sonoma, where the co-ops members it's a distribution company for fruits and vegetables. So there was a worker class and a farmer class, a producer class. And so that starting point of, well, when we have net earnings, when we have net profit, how do we allocate that between the two different classes? Because one is based on hours and the other one's based on produce sold through the co-op. And that took a few months of asking others throughout the nation for examples. And in the end, it becomes a board decision on, number one, how do you allocate the total equity between the two classes? And then on what basis within those classes then do you distribute? So it requires one additional step. Yeah, depending on the dynamics of whatever industry you're in, that's going to probably be the driver of how you decide to allocate that. And what Feed Sonoma did was choose to make the allocation to the different classes 25% for employees, and I think there were 10, maximum 12 employees, and 75% to the member class, of which there are 50 farmers. And well, I'd be happy to go into more of the details of what the logic was, but in the end, the founding board needed to make that decision. Great question about multi-stakeholder co-op. Okay, so
there's one more question that even has, which is what about consumer-based co-ops that are worker operated? And yeah, I can also add some thoughts too on that, but go ahead, Bruce.
Well, I mean, consumer-based, worker operated. I mean, that is what consumer co-op has, the members as the owners and the employees as just as employees. They might also be members, but the basis on which net earnings are allocated are based on that consumer function that the membership represents. So it's by purchases made, purchases through the co-op, not ours. You would have to make a separate class of of membership that is worker, the worker class, and figure out a formula for allocating equity to that class of members. I hope that answered the question, but go ahead, John, to add anything.
Yeah, that's great. Yeah, when it's where it's this kind of goes back to the multi-stakeholder model too. If you have like, for instance, I can share this because it's in their bylaws. So Orca Books, which is both a consumer and worker co-op, they decided to simply defer the any patronage only to the worker members, right? Because the consumers are getting a 10% discount anyways, and the workers are kind of hovering in a low margin industry near minimum wage. So the idea was to give some incentive to the worker members in that case. But you know, I guess the point is you can kind of do what you want to do, what's going to make the most sense for your organization. And there's a fair amount of latitude to it. You're not obligated to do it perfectly, even with different groups. Or, you know, a consumer co-op could also really, again, the point, you know, we talk a lot about patronage and equity, but really the point is to meet members' needs without depending necessarily on the equity. The equity is more about running the organization, and so I think you know, part of it is what is going to work within the mission of the organization, and how does the equity fund that.
Okay. Let's see a time check here. At 12:15, and we got until 1, right? Uh-oh. I cannot hear people.
Yes, you do. 1
Good.
o'clock.
Okay, good. Super. Thank you. Excellent. Yeah, right now I'm looking at a small strip of people and a big screen of my stuff. So yes, I've got just a little bit more to review. One of the things that's new for me is this idea of converting allocated equity to unallocated equity. And because it's certainly not common in agricultural co-ops, and I had not seen the practice in consumer food co-ops, but it's a practice that is widely adopted by worker co-ops. And I've come to realize why it's a good thing to have that unallocated equity, especially when there are, you know, hopefully you don't have very many non-member employees. But when we look at the importance of that unallocated equity, there's two big things. And the first one is that not every year is going to have is not going to be a profitable year, and equity is money that's at risk. And that means that when there is a loss, it needs to be applied to the equity that was already there in the co-op. So that's part of the dynamic nature of equity. And when you have unallocated equity and you have a loss, the first place you apply it to is unallocated equity. And only when that has disappeared do you apply a loss to members. So that's one of the main benefits. It truly is like a reserve and a cushion for the co-op members, so that in hopefully the few years in which there's a loss, it doesn't affect the member capital accounts where each year's allocated equity is recorded. So, and additionally to that, when the co-ops gets bigger and needs to get some loans, some lenders will value more. I mean, they'll just they want to see that unallocated equity and know that it's essentially permanent. And it's the member equity that goes up and down depending on how much the co-op decides to return back to its members on a yearly basis. So not a huge factor, I think, for most co-ops, but it is an additional aspect that that lenders look for, is how much equity is in the business. So, okay. And one thing I did want to clarify, and that I know I have said that, and this common understanding that that each year that the co-op should return between 20 and 80% of that allocated equity to its members, and that's what we call a qualified patronage refund. And I've said, and I've heard other people say that you must do that between 20 and 80%. And when we say must, that is to be able to qualify for the co-op not getting taxed. When the co-op returns between 20 and 80%, then all of that allocated equity is taxable to the members on their own personal income tax returns. But the co-op can decide to do 0 or 100% return, and that's what we call the non-qualified patronage refund. And when that happens, then the co-op does get to pay tax on that in the year that it did that. So when you hear us say must, it's to preserve that that no tax to the co-op status that co-ops have. But it's not that it's an illegal act to not do that or to pick some other number outside of the 20 to 80% range. So, and always, that doesn't make any difference. Anytime you have unallocated equity because you have non-member business, the co-op does have to pay tax on that. So, and is there any clarifying question about that concept? So I am looking to see if we're at 12:20. And I probably want to spend 20 plus minutes. I've got an activity here, but I would like to, or John, you can give me a recommendation here. We can spend a little bit more time on this, or I can move into some of the top level concepts in the acquisition process. And I think that would take about 20 to 25 minutes.
Yeah, if there aren't any further questions, if people feel they have a good grasp, I think we can move ahead. We do have rooms set up if we need to do breakout rooms.
With this small group, not necessary. So I'm sorry, you wanted to recommend that I
think go ahead. Yeah, unless there are other questions that people have. It's
go ahead with more finance and activity, or move to the transaction overview. Say it again.
I think whatever you feel comfortable with. Sorry.
Okay. Well, I'll give that to you. I mean, if you would like to exercise your co-op equity management muscle, we can do a little bit of that. If you would like to turn over to some of the concepts and practices around choices that you make in structuring a deal for selling, buying a business, I can move over to that now.
Yeah.
All right, let's see.
Let's talk about the transactions, I think.
Moving over to that. Yep. So I've got to do a close here. Where do I close? There we go. Screen 2, and then I hit my slideshow. Here we go. Okay. So once we have gotten to an offer, you got a willing seller, you've assessed that that there's profitability, and we've done our pro formas that show you can cover a purchase price, assuming some debt. Then we get to what is the deal structure. And the deal structure involves usually a price and a payment mix. And then we also look to see if we want to choose the method of the transaction as being either an asset sale or a stock sale. And then there are a number of other things to bring into the equation that would affect the decisions that you make around whether it's asset, stock sale, and the kind of payment mix that you want. That payment mix is, yeah, you've heard about loan, earnouts, and sometimes equity involved for the seller for a period of time. So how do we determine the sales price? It comes down to making sure that you can afford the debt that you take on to finance that transaction. Your feasibility study is going to identify what that maximum limit is. And generally, you want to do that in a time frame that is 7 years or less. So the main things that we look for is some projections that make you feel confident about your future cash flow, your ability to carry debt, the current owner's goals, meaning largely how long do they want to stay with the business? Are they exiting at the day of closing or remaining for 1 year, 3 years, 7 years? And also what kind of financing options you have. So I'm going to get to the payment mix here. Yeah, so the main concept here that I want to underscore is that the new co-op pays the sales price of the business out of its future profits. So you got to be pretty confident that things continue on the same, hopefully good track that they've been on, right? So our payment mix is going to be, the biggest part of it is probably going to be a loan from an institution like Shared Capital. And then there are some other parts that make that final payments to the seller sometimes variable, and that is including the an earnout that is based on future performance, and sometimes providing equity to that seller in a form that doesn't undermine the autonomy of the co-op. So we call that non-voting preferred shares for the outgoing seller. That does give them, first in line rights to future net earnings, in using a formula that's set in an agreement. And let's see. Yeah, sometimes I'm talking about 2 slides at the same time. So when we talk about earnout, there's 2 methods of doing that. One is tying yearly additional payments for a period of time, usually less than 7 years, either based on future sales revenue or the future net earnings. And accountants will use EBITDA as that term, as earnings before interest, taxes, depreciation, and amortization. And the sales revenue part is the easiest to calculate. You're just looking at revenue, earnings, and it does not get tied to the overall efficiency of the business. So if things get sloppy on your cost management, your expenses, then that puts you in a more difficult position. And when you tie an earnout to your net earnings, then that does require that things remain efficient. And so it's generally that if you're going to have your seller still part of the business, that and is going to take an active role in management, that you could probably feel more confident in going with EBITDA than sales revenue. So these are two big decisions that need to be made about and come to an agreement about how a future earnout is going to be formulated. And the other way is by giving that seller preferred share in the co-op. And it means it doesn't get any additional voting or any kind of additional governance powers. And can be affixed with a certain percent dividend. So that's not something that you have to use, and I have not actually seen it used, but it is an option to be considered. So that is, yeah, how a seller can get paid with a different form. So you kind of have a base amount that would be given to the seller from the proceeds of the loan the co-op takes for purchasing the business. And then for a period of years, can get an earnout using different formula. So the whole structure of how that conversion happens from business being individual business to a co-op is going to happen either through a purchase of the assets by a new entity that is the co-op, or it's going to be a stock sale in which the co-op essentially steps into the shoes of the existing business. So when we look at a stock sale, you get the whole company. You get assets and the liabilities stay with the co-op, or not stay, they go to the co-op. And has some benefits in that the seller gets a tax break because the entire sale is taxed as capital gains, and the buyer can't depreciate the price paid for the business. So that's what, and this is important. One of the things that you heard shared capital presentation is that sometimes you're having your employee identification number is important for certain government contracts, and if you have to start that process all over again, then you're going to have problems. And what happens in a stock sale is that all of your corporate identification remains the same. It's just that you're changing the form of it. So especially things like your employee identification number, that stays the same. But also, things like any security deposits you have, or any other agreements, your bank account numbers, all that stays the same when you do a stock sale. And that's different when you do an asset sale, because you essentially create the new co-op entity, and you simply buy what is what the selling business assets are. So we've got a new entity. You've got to make sure that you know exactly what assets are on that. If you have equipment, if you have vehicles that are on the balance sheet of that co-op, of that selling business, that you know exactly what's supposed to be on there. So in this case, then the liabilities stay with the seller. And even though the on your asset portion of your balance sheet, you have cash in there, you have and current inventory, they don't necessarily have to be included in the sale. So that's an optional choice that needs to be negotiated. And in this case, the buyer gets a tax incentive because they're able to fully depreciate the cost of the assets. So let me stop here before I do a very quick review of what an example deal summary looks like. This is possibly a lot of new concepts thrown at you at the same time, but anything you'd like to clarify around asset sale, stock sale, preferred shares, earnout methods? Okay. So here is an example here of a business where the valuation leads to an agreement that the sales price is $210,000. And the terms are a loan for 3.75% for 7 years. And the monthly payments then are $2,846.35. And we have an earnout in the mix, and that is, the choice that this example made is based on net earnings, on your EBITDA. And the terms there that we can use an example is 25% over a certain amount, in this case, 25,000. So if things are not going well, if things are lean, and the co-op doesn't show the bottom of their profit and loss statement a number over 25,000, then the seller doesn't get anything for that year, in addition to the basic payment that they got. And written into the agreement is a total cap on the payout. In this case, it could be, the example here is $395,000. And so that is sales price, earn interest, and earnout combined. So that's an example of, I mean, just pared down to its bare bones of what a deal summary would look like. And that I completely overestimated how much time I wanted to take to review these things. I would like to open up the floor for questions, especially considering a number of you are already in the process. Are there aspects about your business that make you feel confident about choosing asset versus stock sale?
Hey, Louis. Yeah, I mean, not to pillage the time, Trillium definitely, I believe, would naturally lean towards that of a stock sale, considering the creation of a new business entity would be a complete disruptor to the clients that we serve. So in terms of business continuity, it makes much more sense for us to be set up for success in this conversion process by doing a stock sale and maintaining that EIN.
Yep. Mm-hmm. Does anybody think that they have a situation in which an asset sale makes more sense?
Yeah, I just wanted to ask whether or not the asset sale then results in the seller not being able to have that taxed as a capital gain.
Oh, let's see. Capital gain. Oh. I'm not confident in that. I have not had to confront that that issue. Stock sale, seller gets tax break because the entire sale is taxed as capital gains.
Right, but what about an asset sale? And it's okay if you don't know. I don't, it's
yeah, no, and I've only been through a stock sale, so I've only got one experience, and it was as a stock sale.
Got it. Thank you.
Mm-hmm. I'm going through one now. I'm going to have to learn about asset sale because I can give you an example of one in which I'm working on, in which the owner has a core business, but as a single entity S Corp has also done some other kind of real estate and property management work that they include on their books. But when the co-op is looking to, when he's looking to convert his core business into a co-op, he only wants to sell that part. He wants to remain doing property management and some other, real estate related work. So he does want to sell off the whole business and mingle, I guess, the monies that have to do with property management and real estate. So it's really clear that this new co-op needs to be formed just to purchase that core business from what the single owner business owner has developed that is diversified. So in some cases, it's going to make more sense to do that asset sale, and that's one example. But I hear you. Stock sale is probably more common.
If I can jump in too, again, one thing about the stock sale is, for the buyer in a co-op sense, that, or I mean, on the asset sale rather, right? There isn't getting that tax advantage for the buyer isn't the same in a co-op because it's not, a pass-through organization, and so you have to think about, but you can depreciate the price of the sale going forward. It's just that becomes maybe part of your equity plan and how you calculate unallocated equity into it, right? So it's just thinking about some of those things. Then I think the other thing for asset and stock sale is just thinking about, general liability issues that aren't necessarily related to debt, but are also related to, just how clean you want to break between the businesses. And sometimes asset sales just give you a much cleaner break than you might want. So those are some other, I think, issues to think about too.
Yeah. I think with the asset sale, we also have to consider all the kind of agreements that you have and relationships that the existing business has with suppliers and with banks. And so maintaining, if you have a line of credit, say, for example, or just terms for payments for inventory or things of that nature, that the selling owner needs to be able to present the conversion to those entities as in a way that preserves the terms that they had developed, and that can sometimes, well, it can be time consuming, and you don't know what the response is going to be. So some additional steps on that side.
Great. Yeah, so I don't know, how are people feeling on this? It's kind of, I usually expect more questions on the financial end, but if people are feeling they're grasping it, then that's a great sign. Let's switch to the gallery view here.
I think for the Trillium team, there's still some things that we're kind of processing and working our way through. So we tend to like to discuss a little bit internally and probably bubble up some questions in our breakout groups. Diane's been amazing at helping us sort through some of those.
Yeah, and I know Trillium does have an accountant they work with. What about the other organizations? It might be a good idea to bring them in to when we do our independent meetings with our staff and you, and maybe bring the accountants in at some point to that conversation. I don't know what people's relationships are. Does everyone have an accountant that they work with already, or?
I mean, I would definitely love to bring mine in if we can. I know he's got questions.
Yeah. Yeah, and I think that's something we can definitely do and share these videos. And we also have, of course, on our website, our legacy video series where attorneys Jason Weiner and Kathy Phillips from Colorado really go through a lot of these in much more detail and with some examples. Each of them run about half an hour. I would recommend sharing those out with your accountants and helping them kind of come up to speed on what the co-op model is and some of the different options too. Well, we're at 10 of the hour. If there aren't any questions or thoughts, definitely meet with people this week and keep working on the financials and trying to build that financial model out. Obviously, the cost projection, if you are looking for working with shared capital, that is going to be something that will be needed at the application process. Even if you're not doing outside equity for the conversion, it's still going to be something that the members are going to want to see, that the sellers are going to want to see. You really want to get your numbers nailed down as really as soon as you can. That's probably in terms of the actual closing on the conversion is going to be the single most important thing in terms of getting the closing done. Next week, we're going to be turning away from the financial discussion and talking more about governance, talking about the board of directors, talking about decision-making in worker co-ops and how to probably change that from your current dynamic. And Annie Hoyle will be presenting, and look forward to hearing from her next week. But otherwise, unless Louise, you have anything else, I'm happy to let people off Zoom a few minutes early. That's never going to be a bad thing.
That's all.
All right. Let's see, is there anything in the chat here real quick? Okay. Well, then everyone have a wonderful afternoon. Try to enjoy what little sun we have today, and we will talk to you next week. And then again, make sure you schedule your one-on-ones as well with everybody.
Great.
Thank you all.
Bye-bye.